Hello, and welcome back to AlgoBot, your channel for clear, practical breakdowns of automated trading strategies for MetaTrader 5. I'm your host here at AlgoBot, and today we're exploring an expert advisor called Triple Smooth Momentum Shift. This strategy is built around TRIX, a momentum indicator derived from a triple smooth moving average of price. Over the next several minutes, you'll learn how the strategy reads momentum, how it decides when to signal a long or a short, and how it manages its exits using a volatility-based stop and a reward multiple target. Everything here is educational, so let's break it down together, one piece at a time. So what does this expert advisor actually do? At its core, Triple Smooth Momentum Shift is a trend and momentum strategy. It reads the pace of the market using an indicator called TRIX, and it looks to participate only when fresh momentum lines up with the broader direction of the market. It's a fully rules-based approach, meaning every decision comes from the same conditions being met, with no discretion or guesswork once it's running. TRIX is worth understanding because it drives the whole system. The strategy takes the closing price and runs it through three moving averages, one after another, in a cascade. Each pass strips out a little more short-cycle noise and single-bar chop. What's left is a much smoother read on the underlying momentum of the trend. TRIX itself is the bar-to-bar percentage change of that thrice-smooth line, so it reads positive while smooth momentum is accelerating upward, and negative while it is accelerating downward. The strategy is described in its source as being suited to a liquid, trending instrument such as a major currency pair, and it defaults to the 1-hour time frame. That said, the code reads whatever symbol and time frame you attach it to, so the same logic can be studied across different markets and chart periods in a backtest. In terms of the type of trader this style tends to suit, it's aimed at those who prefer a momentum, trend-following approach rather than rapid, high-frequency scalping. It acts once per completed bar, it holds a single position at a time, and it filters out a great many marginal signals by design. Now, an important reminder before we go further. Everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. All trading carries risk, and losses are a normal part of trading. Our goal here is simply to understand how this particular strategy is constructed and how its logic behaves. Let's walk through the mechanics step by step. The strategy tracks two references built on top of TRIX. The first is the signal line, which is simply a moving average of TRIX and acts as the crossover reference. The second is the zero line, which acts as a regime gate that tells the strategy which direction the market currently favors. For a long, two things must both be true. TRIX must cross above its signal line, and at that same moment TRIX must already be above zero. In plain terms, momentum is turning up, and it's turning up inside an established up regime. For a short, the mirror applies. TRIX must cross below its signal line, and at that moment TRIX must already be below zero. So momentum is turning down inside a down regime. Why insist that the cross happen on the correct side of zero? Because most losing oscillator signals are counter-trend crosses that appear in the chop around the midline. By requiring the fresh cross to agree with the side of zero, the strategy discards those marginal signals. This is what keeps the number of trades and the associated drawdown lower, and it helps avoid fitting the rules to noise. Now the exits, of which there are three. First, a fixed stop loss based on the average true range. The stop is placed a set number of ATRs away from entry, using the ATR stop multiple parameter, which defaults to 2. Because it's tied to ATR, the stop naturally scales with market volatility. Second, a take profit. The target distance is the reward ratio parameter, which defaults to 1.6, multiplied by that same stop distance. So the target sits 1.6 times further from entry than the stop. Third, an optional early momentum reversal exit. When exit on reversal is switched on, an open long is closed the moment TRIX crosses back below its signal, and an open short is closed when TRIX crosses back above its signal. This releases a stalled trade before it can round trip. A few housekeeping rules complete the picture. There's a spread filter, so a signal is skipped if the current spread is wider than the max spread point setting. The strategy manages only one position per magic number at a time, and it acts strictly once per newly closed bar, after a warm-up period that lets all three smoothing passes and the signal line converge before any cross is trusted. Let's look at the actual MetaQuotes language code the way you'd see it in MetaEditor. At the top are the inputs, and these mirror the strategy's parameters. TrixPeriod, defaulting to 15, is the length used for each of the 3 smoothing passes. SignalPeriod, defaulting to 9, is the length of the signal line drawn on TRIX. Then we have AtrStopMult, the stop multiple, the reward ratio, the maximum spread, the reversal exit switch, the lot size, and the magic number. Below the inputs, the strategy builds its decision. The variable cross-up is true when TRIX moves from at or below its signal to above it, and cross-down is the opposite. Then notice how long signal requires cross-up, and, in addition, that TRIX is greater than 0. And short signal requires cross-down, and that TRIX is below 0. That extra check against 0 is the regime gate we discussed. Just above the entries, the code computes the stop distance as the ATR multiple times ATR, and the take-profit distance as the reward ratio times that stop distance. Now look at the buy block. When long signal is true, it reads the ask price as the entry, sets the stop loss below the entry by the stop distance, sets the take-profit above by the target distance, and calls trade.buy. The sell block is the mirror image. When short signal is true, it reads the bid price, places the stop above the entry, the take-profit below, and calls trade.sell. Same structure on both sides, simply reflected for direction. Let's bring the whole strategy to life on a chart. The candles run across the top, and beneath them sits the TRIX panel. The gold line is TRIX itself, and the blue line is its signal. The dashed gray line through the middle is the 0 line, our regime gate. Everything above 0 is treated as an up regime, shaded green, and everything below 0 a down regime, shaded red. On the opening candles, price is easing back after an earlier advance, a modest pullback. Notice in the panel that TRIX is still above the 0 line, so the strategy still regards this as an up regime. But the gold TRIX line has slipped just beneath its blue signal as momentum cools. The strategy waits. It does not act on a cross that would point against the regime. By the 4th candle, price stops falling and closes higher, curling back up. In the panel, the gold TRIX line turns and crosses back above the blue signal. And crucially, this happens while both are above the 0 line. That combination, a fresh upward cross confirmed on the correct side of 0, is exactly the long condition. The buy entry marker appears on this candle. At that same moment, the strategy measures the current average true range and places a stop below the entry, a set number of volatility units away, then projects a take profit above at the reward multiple of that stop distance. From there, the following candles push higher. TRIX climbs, the signal trails beneath it, and the up regime stays intact. Notice that because momentum keeps agreeing with the trade, the optional reversal exit is never needed here. Price simply advances, candle after candle, until it reaches the take profit target and the long position is closed for a completed move. Remember, the reward to risk on this trade is 1.6 to 1, meaning the target sits 1.6 times further from entry than the stop. Now the picture shifts. Around the 8th candle, price stalls and prints a lower close. And in the panel, TRIX rolls over and dips beneath its signal. But look carefully. TRIX is still above 0 at this point, so this downward cross does not qualify as a short. The strategy stays flat and waits for the regime itself to change. This is the 0 line gate quietly doing its job, filtering out a signal that would fight the prevailing direction. Over the next candles, price declines steadily. TRIX falls through the 0 line, and the panel shading flips to the red down regime. Then price makes a brief bounce. You can see one candle close higher, and the gold line pops up above its signal for a single bar. Then momentum fails again. On the next candle, price closes sharply lower, and in the panel, TRIX cuts back down through its signal, while both are now below 0. That mirror image condition, a fresh downward cross confirmed below 0, is the short condition, and the sell entry marker appears here. The stop is placed above the entry at the same volatility distance, and the take profit is projected below at the reward multiple. Price then works lower over the final candles, following the down regime, until it reaches the short take profit target, and that position is closed as well. 2 complete trades, one long and one short, each entered only when a fresh momentum cross agreed with the side of the 0 line, and each exited by a predefined target. That agreement between the cross and the regime is the heart of what this strategy is designed to do. Of course, not every signal reaches its target in real conditions, and losing trades are a normal part of any approach. This illustration simply shows the intended logic clearly. So there we have it. Today we walked through triple smoothed momentum shift, an expert advisor built on the TRIX momentum indicator. We saw how 3 cascaded moving averages smooth price into the TRIX line, how a cross of TRIX and its signal line is gated by the zero line to keep entries aligned with the regime, and how the strategy manages risk with a volatility-scaled AtrStop, a reward multiple take profit, and an optional momentum reversal exit. We also read the core buy and sell blocks directly in the code. If you found this breakdown helpful, please consider liking the video and subscribing for more MetaTrader 5 strategy analyses. And let me know in the comments which strategy you'd like us to examine next. You can find more at www.algobot.live. And remember, this content is for educational purposes only. It is not financial advice, and all trading carries risk. Past performance does not guarantee future results. Trade responsibly.